Listen carefully, because what you're watching is not a freak headline, not a one-off intelligence leak, and not just another Middle East complication. What people call a stealth deal between China and Iran isn't random. It's the predictable output of a machine, a system with rules so consistent that once you see the gears, you can forecast the next move before officials admit it's happening. Here's the claim, stated cleanly. When a global power runs a sanctions-based order, while its debt load and security perimeter expand faster than political consent can sustain, and a rival power builds parallel trade and payment rails to route around that order, then a stealth deal isn't a surprise. It's the next scheduled phase. It's the system doing what the system always does. And I'm not asking you to take that on faith. We can anchor it in numbers that sit in public reports. UN Trade and Development said global public debt reached about $102 trillion in 2024. The Institute of International Finance put total global debt, public plus private, around $313 trillion in 2023. And inside the United States, the Joint Economic Committee's February 2026 update tracked gross national debt at roughly $56 trillion as of February 4th, 2026, noting it has been climbing by billions per day. That's the pressure environment. That's the oxygen level in the room. Now here's the pivot that keeps viewers locked in. This isn't about one shipment, one meeting, or one secret document. It's about a pattern. And once you see the pattern, you stop asking, what did China secretly give Iran? Like the answer is hiding in a single crate. You start asking the only question that matters. What stage of the pattern are we in? And what does the next stage always look like? Because if you can answer that, you can front-run the narrative. And in markets, front-running the narrative is the difference between reacting late and positioning early. So let's define the mechanism, 4 stages. Not because history is poetic, but because incentives are mathematical. First, a dominant power builds a system other nations must use. Trade routes, reserve currency settlement, security guarantees, payment networks, insurance and shipping lanes, clearinghouses, standards, institutions. The system is efficient, so everyone plugs in, even the countries that resent the center. Second, expansion and overreach. The center extends commitments, military, fiscal, political, because the system makes it feel affordable. Cheap financing, deep capital markets, the privilege of being the hub, but costs compound. Debt grows, security obligations multiply, and the center starts leaning on coercion, sanctions, exclusions, asset freezes to enforce obedience. Third, the parallel build. Challengers and sanctioned states construct workarounds. Quietly, a swap here, a new corridor there, a new insurer, a new bank, a new settlement mechanism. They don't need to replace the dominant system overnight. They only need to reduce dependency enough that punishment stops working reliably. Fourth, the inevitable outcome. Once punishment stops working, the dominant power's choice set shrinks. It either escalates, financially, militarily, covertly, or accepts erosion of control. And because credibility is the core currency of a global order, the dominant power usually escalates to defend the perception of control, even when the math is turning against it. That's the machine. Now we prove it 3 times, because 1 example is a story, but 3 is a mechanism. First proof, Britain, sterling, and the moment the empire learned it couldn't police the price of its own credibility. Stage 1, Britain sits at the center. London clears trade. Sterling lubricates finance. Naval power protects routes. Capital flows through the hub. Stage 2, commitments outgrow capacity. 2 world wars turn into balance sheet stress. The empire's obligations remain while relative industrial dominance fades. Britain tries to defend sterling credibility and global commitments at the same time. Stage 3, alternatives grow. The US dollar rises. Bretton Woods formalizes a new center. Trade invoicing, reserves, and financial gravity shift, gradually at first, then faster. Stage 4, a credibility test exposes constraints. Suez in 1956 becomes the symbol. Britain discovers that acting without financial independence is a trap. Currency pressure forces retreat. After that, every threat costs more and buys less. Second proof, the United States, Bretton Woods, the Nixon shock, and the 1970s. Stage 1, after World War II, the U.S. anchors a system with industrial power, military reach, and a dollar linked to gold. The world trusts the promise. Stage 2, commitments expand. Domestic spending rises. Cold War posture rises. Vietnam strains budgets. Liabilities grow faster than the discipline required by convertibility. Stage 3, the world hedges. Countries convert dollars to gold, reduce exposure, and prepare for instability. The workaround spreads. Stage 4, 1971, ends gold convertibility, the Nixon shock. The promise ends because the math ends it. The 1970s bring inflation and energy shocks, and markets learn that when an anchor breaks, volatility becomes the tax everyone pays. Third proof, the Soviet Union, because the mechanism applies to any system where commitments exceed capacity and exits become viable. Stage 1, a sphere of dependence forms through alliances, coercion, energy, and arms. Stage 2, commitments expand under stagnation. Afghanistan in 1979 adds cost and strain. Productivity lags. The system becomes brittle. Stage 3, legitimacy and economic gravity shift outward. The periphery explores autonomy. Once exits become imaginable, fear loses power. Stage 4, unraveling accelerates in the late 1980s and ends in dissolution in 1991. It looks sudden only to people who missed the parallel build phase. Now pause, because this is where you pull the viewer back. If all three cases follow the same stages, the only rational question is, where are we now? Not who is the villain, not who started it, not what did someone tweet? Where are we in the machine? Now we apply the stages to the present, step by step, like an audit. And after each step, we stamp it the way markets stamp reality. Stage 1 in the present, the setup. The United States runs the hub system. Dollar settlement, US anchored financial plumbing, global clearing access, and a sanctions toolkit that can freeze assets, block banks, restrict exports, pressure insurers, target shipping, and isolate adversaries from deep capital markets. Alliances reinforce it. Access is conditional. If you want in, you comply. If you defy, you risk exclusion. Check. Stage 2, expansion and overreach. Commitments layer on top of commitments. Debt rises and interest costs become an accelerant. The February 28-26 debt update puts U.S. gross national debt around $56 trillion as of February 4. Widely reported projections show large deficits persisting and debt climbing toward roughly 120% of GDP by 2036, with net interest costs rising. Verified. You don't need ideology to see the constraint. Higher debt means higher interest sensitivity. Higher sensitivity means less flexibility in crises. Less flexibility increases reliance on tools that feel cheap in the short term, sanctions and financial pressure, because they look like power without immediate budget votes. Undeniable. Stage 3, the parallel build. Iran is sanctioned. Sanctions work when they isolate. Sanctions weaken when the target routes around them. China has motive and capacity to help build that routing. Energy security, leverage, and proof the US toolkit isn't absolute. Check. So what does the parallel build look like in practice? It looks like oil still moving through networks designed to survive enforcement, ship-to-ship transfers, blending, reflagging, and intermediaries. And here's why that's not speculation. In early February 2026, the U.S. State Department announced sanctions targeting illicit traders of Iranian oil and what it explicitly called a shadow fleet. If the routing didn't exist, you wouldn't see that response. Verified. It looks like payment workarounds, rails that reduce exposure to U.S. sanctions. Reporting has described hidden mechanisms and indirect channels used to keep payments moving while avoiding obvious choke points. Call it a stealth conduit or parallel settlement. The label doesn't matter. The function matters. Keep Iranian supply and Chinese demand connected while reducing enforceable pressure. Undeniable. It looks like long-horizon frameworks that normalize cooperation. China and Iran signed a 25-year cooperation agreement in 2021. Whether every promised project materializes is not the point. The point is institutional direction under sanctions pressure. Check. It looks like alternative forms. Iran's entry into the BRICS expansion effective January 1st, 2024 doesn't replace the dollar tomorrow, but it expands access to partnerships and political cover. Parallel systems begin as options, not replacements. Verified. And it looks like security normalization. Joint naval drills and repeated coordination make cooperation routine. Routine reduces friction. Reduced friction makes deeper alignment cheaper later. Undeniable. And here's the detail most scripts skip, even though it's the very thing that holds attention. Parallel build doesn't just happen in government offices. It happens in spreadsheets, shipping manifests, and compliance departments. It happens when a trader asks, "Can we insure this cargo?" And someone answers, "Not through the usual channel." It happens when a bank asks, "Can we clear this payment?" And someone answers, "Not through the usual correspondent." Then the next question becomes the only one that matters. Can it still move? That's how the system mutates, not with a speech, with a workaround that becomes routine. And once routine sets in, the market starts quietly repricing the world in 3 layers. Layer 1 is energy flow. If Iranian barrels keep moving into Asian demand, the obvious conclusion is that the global market is more supplied than the sanctions narrative implies. But the risk premium can still rise, because supply that moves through gray channels is fragile supply. It can be disrupted by enforcement, by miscalculation, by insurance shocks, or by a single incident in a narrow waterway. So you get a strange combination. Supply exists, but the price of interruption rises. Layer 2 is payment architecture. If payment can be rerouted, the sanction weapon loses some bite. But rerouting adds friction, higher fees, longer settlement times, more intermediaries, more legal risk. Friction is a hidden tax. Taxes show up as wider spreads, higher costs of capital, and lower growth at the margin. Layer 3 is credibility. When markets sense that a rule is becoming optional, they don't wait for an official announcement. They start demanding a premium for uncertainty. The premium doesn't appear only in oil. It leaks into credit, into emerging market funding, into defense spending expectations, into currency hedging, and into volatility itself. So if you're a retail investor watching this, the question isn't, will the dollar collapse tomorrow? That's a cartoon. The real question is, how fast do parallel rails reduce the reliability of enforcement? Because the moment reliability drops, the response function changes. Policymakers react faster, militaries posture earlier, insurance markets tighten sooner, and the odds of a sharp surprise repricing go up. That is why this is urgent. Not because doom is guaranteed tomorrow, but because the probability distribution is shifting underneath you. And when probabilities shift, the best move is preparation. Know what you own, know what it correlates with in stress, and decide your risk limits before the headlines force decisions in the middle of panic. Now, stage 4, the inevitable outcome. This is where the alarm comes from. When sanctions stop reliably stopping revenue, resilience rises. When resilience rises, deterrence calculations shift. When deterrence shifts, the U.S. must spend more, militarily and diplomatically, to achieve the same control it once achieved more cheaply. Check. Visible readiness signals reinforce that reality. Reporting has described preparations for additional U.S. carrier presence amid rising tensions. That isn't a casual move. It's a credibility signal. It says, we are preparing options. It says, we are not sure the old tools alone will hold. Verified. Now translate this into the cold logic your audience must hear. If the parallel build improves, the U.S. menu narrows. Option 1. Accept that sanctions are no longer absolute and shift toward containment and selective deals. Option 2. Escalate enforcement, more seizures, more sanctions, more pressure on intermediaries, and risk retaliation and oil market shocks. Option 3. Escalate militarily or covertly to restore deterrence and credibility, with feedback loops that can spiral. Whichever option is chosen, the cost rises, because the cheap era of enforcement depended on near monopoly control of the rails. Parallel rails erase monopoly power. That is the stage shift. Undeniable. Now here's the retention hook, because it compresses the whole episode into one clear truth. A stealth deal is rarely about ideology. It's about liquidity, energy, and leverage. Iran needs revenue and strategic depth. China needs discounted energy and leverage. The US needs credibility, because the order runs on enforceability. Rules that can't be enforced stop being rules. They become suggestions. Check. That triangle creates the same pressure structure every time. The hub punishes, the target routes around, the challenger builds the route, and the hub escalates to defend credibility. So when you hear China's stealth deal with Iran alarms the US, hear the real message underneath. The parallel rails are getting good enough that the old choke points aren't guaranteed anymore. And that's why this matters for markets. Not because it's dramatic, but because it changes the price of risk. If the world believes enforcement is airtight, risk premiums stay contained. If the world starts believing enforcement is leaking, two things happen at once. Adversaries get bolder, and the hub's response becomes more expensive. That raises the probability of disruption. Markets don't price what you believe. Markets price probabilities, verified. Now dismiss the comforting myths that destroy portfolios. Myth 1. The US can absorb any cost forever. No system absorbs unlimited cost. Strength does not cancel arithmetic. Debt service rises. Strategic theaters multiply. Capacity is a balance sheet, not a slogan. Check. Myth 2. Technology will save us. Technology changes tactics. It doesn't erase geopolitical constraints. If parallel payment networks reduce enforceability, software doesn't restore monopoly control overnight. Incentives don't vanish because tools improve. Undeniable. Myth 3. Everyone needs the dollar, so nothing changes. Need is a spectrum. Parallel build doesn't need to eliminate dollar dominance. It only needs to reduce dependency enough that punishment becomes unreliable. Erosion happens at the margin, quietly, until it doesn't. Verified. So what does a finance-minded viewer do with this without panic? Stop watching geopolitics like a soap opera. Watch it like a balance sheet and a volatility map. When Gulf pressure rises, watch oil risk premium. When oil risk premium rises, watch inflation expectations. When inflation expectations rise, watch yields and central bank constraints. When yields rise, watch equity valuations. compress, especially long duration risk. When volatility rises, watch correlations converge in safe haven behavior layer. Dollars and gold can rise together when the market wants liquidity and protection. Check. Now here's the practical takeaway that turns fear into positioning. Position yourself for regime uncertainty, not a single headline. First, treat energy shocks as financial shocks. In this machine, oil is a macro lever that hits inflation, rates, consumer demand, and politics. Ignore that, and you're not diversified. You're blind. Second, treat sanctions news as liquidity news. When sanctions tighten, watch shipping costs, insurance restrictions, payment disruptions, and second-order effects on firms tied to trade routes and emerging market finance. The market often reprices second-order effects after the headline fades. That's where opportunity and danger hide. Third, treat escalation risk as correlation risk. In calm markets, diversification behaves politely. In stressed markets, correlations converge. Build as if that convergence will happen, because eventually it does. Verified. Now end where we began, because this is the line the audience will remember. The pattern is absolute because it is incentive-driven. A dominant system expands commitments because it can. Debt accumulates because it feels painless until it isn't. Targets and challengers build parallel rails because survival demands it. And once parallel rails work, the dominant power faces a shrinking menu and rising costs. That's the machine. And what people call China's stealth deal with Iran is the machine revealing itself. Again, so don't get hypnotized by the headline. Don't argue over whether one report is exaggerated. That's not the signal. The signal is visible. Enforcement actions against illicit networks and readiness, moves designed to defend credibility. That is not what governments do when they feel fully in control. That is what they do when they feel control slipping. Undeniable. And if you want to understand what happens next, how the machine was built, why the next stage accelerates, and how markets reprice when credibility is tested, then you need to be here for the next video. Subscribe, because the people who survive regime shifts aren't the ones with the hottest takes. They're the ones who see the pattern early, position calmly, and refuse to be emotionally manipulated by noise. In the next episode, we map the next stage, what it looks like when enforcement stops working consistently, how escalation becomes the default tool, and how the market begins pricing a world where old guarantees are no longer guaranteed. And when that happens, you don't want to be the last person realizing the machine was always there.